that's a good thing.
Good morning, folks. I'm Kathy Kokos with Kitsap Economic Development Alliance. I am stepping in for Joe as your host today. Joe is out of town, and so the team is carrying on in his absence. We're happy to see you here today. And just a quick change. We had two topics planned for you today, and we're really just going to focus on the long-term insurance. There's a lot of information coming out on it. It seems to be changing a bit as far as what options you have. So that is the plan for the day. And before we get to our two stellar speakers, we're just going to go through a few housekeeping notes. So, Teresa, the next screen. Yeah, so today we have David Beck and Dan Weedin who will be with us, and they'll tell us more about their background, but these are both great partners for KEDA and for your company. And we just, are looking forward to all the knowledge that they're going to bring to us on this. Next. I don't know how many folks have traveled to the Small Business Flex Fund website. This is not a grant. It is a loan with some great repayment options. I do know from one of our state economic development organization meetings that there are companies in Kitsap that have taken advantage. But if you have not checked this out and you are looking for a low interest flexible loan, I encourage you to check this out. This is a fairly new program from the state called Flex Fund. And in next month's Kitsap Digital Hour, we're going to be talking about women, work, and family, and that continuing balance, including childcare. In October, well, our fingers are crossed. We are going to be live for our fall forum at the Kitsap Conference Center. We will be rolling out more details on that as we secure speakers, but we hope you can set that time aside on your calendar today so that you can join us. Also in September on the 9th, it's an evening event. We are collaborating with the City of Bremerton's Racial Equity Advisory Council and Washington PTAC to help BIPOC-owned businesses learn more about selling to the government. And the Washington PTAC team that's here in Kitsap will be sharing their knowledge. So we hope you can set that aside as well. Share that with any companies that have ever considered selling to the government, or maybe you're curious about how it works. So join us then, and that will be Zoom. So with that, I think we're ready to turn it over first to David Beck. And David, if you can just give them a quick, background on yourself and how you have become so passionate about working with small business, that would be great, because I do know that is a passion of yours. So thank you.
Well, thank you very much. Appreciate it. Yes, my name is David Beck. I'm a financial advisor at a independent financial services firm called One Strategic Capital. We are located on Bainbridge Island. There is about 15 of us, 5 financial advisors and 10 support staff. We have been KEDA members for 3+ years and have really enjoyed the opportunity to be part of the community and actually to be part of communicating, financially important matters to the organization as a whole, and each one of you as well. Joining me today in kind of a freewheeling discussion about a very important topic that we will be spending time on is Dan Weedin. Dan is the president and owner of First Underwriting Insurance. I hope I said that right, Dan?
Close enough. I'm with First Underwriters Insurance and Emerging Risk Solutions. So,
okay, terrific. Yep. You want to share a little bit about your company and everything before we go?
Sure. I know a lot of the people who are attendees, we know each other, but what I do is I work with small and medium-sized businesses to help them to be ready and prepared for any type of calamity. I work from a consulting standpoint on risk management. I am also an insurance broker affiliated with First Underwriters Insurance. And the reason that we're free flowing this is my life has been long-term care insurance, it seems, since about February. And I know David and I have spent a lot of time with our own clients on it. So he and I are going to share what we know with you today.
Right. Thank you. So, this will be a little disjointed, and in some ways that's probably going to be good because I know there'll be a lot of questions that get generated and so on and so forth. So one last thing I'll say before I go, just to put a little bit more of an emphasis on what we do here as well. We have basically a two-pronged approach in our service. One is for corporate retirement plans like 401k plans. We have a significant portion of our resources that go to advising on those plans. And we also do individual wealth management and financial planning. Okay, having said all that, and the plugs have been placed properly, let's move on. Let's see if we hit the, okay. So what we're going to talk about today is something that a lot of folks have not been aware of, have not heard much about, but it's going to impact all of us who work in the state of Washington, all of us meaning all those who have W-2 income. The Washington State Legislature back in July of 2019 signed into law the Washington State Long-Term Care Act and Trust. And basically, what that means is that the state is attempting and will set up a long-term care benefit for all the state employees so that it will help people who are most vulnerable in our society and to help bolster the cost that state is covering for Medicaid services. Right now, the state spends over $4 billion a year for supporting those who need Medicaid. And typically Medicaid recipients are those who need or have long-term care issues that they need help with financially. So it's a very important trust, but it is going to have an impact, and that cost is going to be shared by all of us in the state. So we're going to discuss not only the act, we're going to talk about how it might affect you, and we're going to spend a fair amount of time talking about the importance of long-term care and why it's such an important piece of your overall financial strategy. Okay, as I mentioned, it was signed into law back in July of 2019. We don't have to spend a lot of time there. But the intent of the law, like I said, is really designed to help the most vulnerable in our society. And as you will probably notice as we move through this, for some folks for some employees, this is going to be a godsend. For others, maybe not so much. And we'll discuss why that might be the case. Okay, so how is this going to affect you? Well, this is a mandatory payment system. So there is going to be assessed on all W-2 income a premium tax of 0.58% on all wages that flow through your 1040. So, and Dan, you certainly add to this, but it's not only wages, it could be commissions, bonuses, vacation pay, anything that flows through your 1040 would be subject to this tax. You might ask, well, what do I get in return for that? Well, the benefit, the long-term care benefit, is a lifetime maximum of $36,500. Again, for some, that could be a godsend. For others, that may not pencil out very well. And we'll discuss that in more detail in a little bit. So who qualifies for the benefits? Well, you need to at least work 500 hours per year. And you also have to pay premiums for at least 10 years. And out of those 10 years, 5 years has to be consecutive payments. So in other words, in essence, you have to pay into the system for 10 years to be able to qualify for the maximum benefit of $36,500.
David,
Now,
would you mind if I jumped in really quickly? I don't mean to.
Sure, go ahead.
I think what's important too, out of that $36,500 lifetime maximum benefit, is it's $100 a day. So the state's not going to write you a check for $36,500 when the
Right.
time comes. It's a reimbursement model that says we'll pay you $100 a day. So
Right.
I just wanted to make sure that that was part of it.
Yeah, no, good point. And this is how we're going to free flow it. Okay. So don't hesitate. The last thing is, or not the last thing, but the other thing that we need to be aware of is for those who may not have a 10-year window left in their employment life. There is an exception where if you pay premiums 3 of the last 6 years of your working life, then you would be entitled to a pro rata solution to that maximum benefit, which at this point in time, we don't know exactly how that is going to roll out. At least I'm not aware of it. Okay, so let's just take a look at where you may fit on the income scale, and let's take a look at what kind of tax you may be obligated to pay. Now, again, these are annual premiums that you would pay into the system. So if someone is making $50,000 a year, you would pay $290 per year. Now, in Dan's case, he's making over $1 million a year, and he would pay $5,800 a year. So I had to slip that in. But the point is that regardless of what your income is, it is all going to be taxed at that mill rate of 5.8%. Okay. So from a logistics standpoint,
Hey, I'm gonna really free flow, David. Could you go back one slide?
Yep.
So you put this in there, and I think this is incredibly important. The premium assessment rate can be changed every 2 years.
Right.
And I think if it's okay to bring that up,
Yeah, absolutely.
I think the state, I'm hearing rumblings, and David, you might be too. I'm hearing rumblings that the state is amazed that so many people have been want to opt out, and they're concerned because they were expecting them to pay. And they're already saying we may not be funded well enough. I would not be surprised that at the first opportunity in 2 years that 58-cent rate is going to go up. I don't know about you, David, but that's my inkling.
Yeah, they did some significant actuarial studies and felt really comfortable at the onset that they would be secure in how they finance the trust for 30 years. But as Dan said, I think a number of people have looked at this and said, wait a minute, if I'm 30 years old and I pay into this system for another 30 years, am I getting a benefit that's worth anything at that point? Now, to add to what Dan just said, there is a committee, supposedly there's a committee that's being formed of 8 people who will, on an every 2-year basis, take a look at the Washington State CPI number and make adjustments so that the benefit keeps up with inflation. But as you probably can imagine, if they're doing that, there's probably a chance that they'll also increase the mill rate on the taxes that they might need to bring in. So yeah, this is a very fluid situation at this point in time. Anything else, Dan, before I move on?
No, that was great. Thank you for letting me do that.
All right. So here's some dates to keep in mind. And I know there'll be questions about this when we get done, but this all starts January 1st of 2022. That's when the first payroll deductions will happen. Now, understand this, that this Washington State long-term care is one of 4 pieces of legislation that's been working its way through the process since 2017. One was the paid sick leave. The other was a $15 an hour minimum wage. And the next one was a paid family leave. And then the last piece of that 4 puzzle is the Long-Term Care Act. Now, know that the first 2, the paid sick leave and the $15 an hour, the onus is on the employer for that piece, those 2 pieces. The paid family leave and the long-term care is totally the responsibility of the employee. The only thing that the employer has to do is make sure that the distributions are made out of your W-2 and sent to the appropriate location. So there is an opportunity to opt out of the system, which we'll get into more detail. But first, before we go in that direction, people that are self-employed or are independent contractors, in other words, they're 1099 employees, they are automatically opt out of the system, but they may opt in before the 1st of January. And for some, that may make sense. And we recommend that you give us a call or talk to your financial advisor about what direction might be the best for you. The other thing to realize is the first claims actually won't be paid until 2025. And the reason why it's 2025 is because that last portion here, who qualifies for benefits for those that have less than 10 years to work, if they do make this minimum hurdle, they would be eligible in 2025, theoretically, to be able to get some level of benefit.
David, on the self-employed, could you go back to that I got a lot of questions on this. You might have too. Self-employed is defined by the state as like a sole proprietor. It's not the CEO of an S corporation or a C corporation or even an LLC. Most of my clients who are business owners get a W-2, and because they may think I'm self-employed. Well, you're not. You must you're qualified to pay the tax. So I just want to make sure, because I have had a lot of questions on that.
Yeah, if you own an S corp as an example, and you pay yourself a wage from your S corp, that's a W-2 wage, and that does qualify you to pay into the system. Good point, Dan. Thank you. Okay, we talked about the benefits increasing and how they've set the mechanism up for that, and most likely you can imagine the tax rates will probably increase over time. And again, according to what Dan was saying, the state may be reassessing that point right now because of the number of folks that are trying to opt out. Now, there's some differences here between the Washington state plan and a traditional private long-term care option. Usually with a private long-term care option, you have to qualify to be able to get benefits. And in that situation, usually it's 2 out of 5 or 2 out of 6 activities of daily living that you have to substantiate that you cannot perform, and therefore qualify to get the long-term care benefit for the policy that you own. For the state, they're actually saying 3 out of 10 activities of daily living. And in some respect, there is some positive news here. So I'm not going to go through all of these, but you can see it by reading it, that if you're having difficulty with any one of these, you have to have at least 3 that you qualify for. The one thing that I think is a positive here is that they are including cognitive impairment. And I think for most of us who are on the downside of the hill, so to speak, as far as age goes, that's a worry for a lot of folks, because we are living longer and cognitive impairment is probably going to be part of our history. So just know that if you can only qualify for 2 out of the 10, you won't qualify for the benefit. You got to have a certified physician or someone who certifies that you are not able to perform at least 3 out of those 10. Okay, there'll be questions about that later. So who is not a participant? So the good news for those who have already retired is you're exempted out of the system. Since you're not getting W-2 wages anymore, you are no longer paying into the system. Something that I think is really important, the reason why we bolded this, is the fact that if you no longer reside in the state of Washington when you could or do qualify for benefits, you will not receive them. So what that means is if you have an inkling of wanting to move out of the state to retire in Arizona or Florida or wherever, if you leave the state, then you will not qualify for benefits, because these benefits pertain to folks who provide those services inside the state of Washington. So another example, let's say you live in Idaho or you live in Oregon, and the company you work with is registered and domiciled in the state of Washington. You will pay into this particular trust. You will fund the long-term care benefit package, but you will not receive the benefit because you do not live in the state of Washington. The last thing I'll say is that you do have to meet your vesting requirements. So if you pay into the system for 8 years and leave the state, then you will not qualify for any prorated investments or prorated benefits. Okay. So I'm not going to spend too much time on that because we're going to cover all that later. So I'm going to kind of turn this over to Dan a little bit because he's got some personal stories that I think will really bring home the point. But I do want to mention this one thing first before I do so. We are financial advisors, so we advise people. We do a lot of financial planning. We do a lot of retirement planning. And typically what happens when we ask people what do they see as the biggest risk in retirement for them, typically they'll say one of three things. It's, well, I'm concerned about future taxes. And I think you can all come to the same conclusion that there's a pretty strong possibility that taxes will increase instead of decrease in the future. The other issue is inflation. Now, inflation has been dormant for a long period of time, but it has shown and reared its head, so to speak, in the last 6 months or so, where we've seen inflation at higher levels than we've seen in a long time. The question is whether that will persist or not. That's a $64 million question at this point. The last one is market volatility. And what we mean by that is most of us have a considerable amount of our resources invested in the stock market. Why? Because none of us are healed, financially healed well enough where we can finance our own retirement out of the chute. So we need help from the marketplace. We need the ability to invest in assets that will appreciate over time. But in doing so, there is volatility that goes along for the ride. It's called risk. Those are the three that I think most people would say when we ask them that question. But actually, what really is the biggest concern is longevity. People are living longer. In fact, studies say that a couple who's 65 years old, there's a 70% chance one of them is going to live well into their 90s. It wasn't all that long ago that the average life expectancy was 45 years. Now that goes back 100 years, but as you all know, we live in a society where some of us are living considerably longer. So just think about having to plan for 30 years of your life when you're not working. I mean, that's a daunting task if you think about it. That's a lot of life without a potential steady income because you are no longer either able to work or choose not to work. So I won't spend a lot of time on this. Dan, I think you've got, he and I both are coming from the same situation that we think long-term care is a vital part of your overall financial strategy. Dan, you want to add some comments there?
Yeah, I'll tell my story really briefly because I know there will be some questions and I'm coming from it a lot from the insurance side because that's part of what I offer and there's some real limitations that you need to know about. But let me start with why I'm an evangelist for long-term care insurance. About 10 years ago, my mom and dad both went into long-term care at the same time. My dad had bladder cancer and was required, because he needed a catheter, was required to go into skilled nursing. He had always said he was going to leave his home feet first. He was right, but he didn't leave it dead. He left it very much alive and needing more time and care. And so when he and my mom moved into the assisted living, he went in, by the way, with only a couple activities of daily living not needed. I don't think he would have qualified under the plan. He did not have a cognitive impairment, so I don't know if he would have qualified.
Yeah.
But the long story short of this is he lived 5 months. We made a bunch of payments. I started writing checks for him. I was his durable power of attorney for financial, and I highly recommend that for anybody who's getting into their 70s or more, that you have, if you have children who are going to do that they do it because it was important. I started writing checks, and the first $10,000 check I wrote got me to look at my own long-term care, which I'd purchased. I had purchased a $3,600 a month policy. I quickly went and bought another one because I realized that if in 2011 my parents needed 10 grand, who knew what that would be 40 years later?
Right.
My dad lasted 5 months, passed away. We brought my mom into home health care, which also counts as long-term care. My parents were straight middle class. My dad spent 30 years in the Navy, another 18 years in the school district, had a very nice retirement, had a nice home out in Deer Run in Paulsbo. My mom stayed with us for 2 years. And then when that exceeded our pay grade, we moved her into memory care. Bottom line, after 4 years, we realized that between their money and my wife and I's money, because by the time there was a year and a half left, we'd gone through all of my parents' money. All my mom was getting was her retirement benefits from my dad, which was about $1,400 a month. The bill was $5,200. My wife and I supplemented that for about 2 years. Between all of us, we estimate roughly $400,000 went into their care, straight long-term care, between home health care, assisted living, memory care, all of that. And so I'm an evangelist for this. Even if you could self-fund, I don't know why you would, because you'd have to put so much money aside in a very conservative format to make sure that it was going to be there for each person. And that within itself is an insurance premium is well less. So my story, that's the reality. And many of you have a similar story that you're either going through now or have gone through. The money is real. The event is real. And as David said, as we get older, by the way, in the world we live in a country that are probably all of us who have the same access to health insurance and medical care and technology, if you hit age 65 and you're still alive, your mortality goes to 93 years old. So when we saw recently that the mortality rate went down because of COVID, the truth is that if you hit 65,
Right,
you're gonna likely make it to at least 93, if not longer. And what research shows is also if you hit age 65, you have about a 70% chance of needing some form of long-term care. David, do you mind if I bring up what's available for the opt-out right now from what I've seen? Is that okay?
actually, yeah, go ahead. That's
No,
fine.
if you have it, I'll go ahead and wait. But that's the reality of the situation. I just saw Joe draw 36,000 as a drop in the bucket. Yeah, I'm telling all of my clients, whether you're paying this tax or not, you still need long-term care insurance. So David, I'll turn it back over to you.
Well, you just tell me if this isn't in line with what
Okay.
you were looking for. So I won't cover that because you just you just set the stage rightly so for the fact that we are going to be older. Longevity is certainly going to be an issue. So the question everybody has is there a way I can opt out of this system? And there's right until just recently there were some options that we will go through, but I don't know, Dan, should we lower the hammer now, or do you want to do it?
Well, we have a half an hour left. And so I go ahead. I'd say go ahead and go, but I think we may have a number of questions and I'll try to keep answering them in real time too.
Okay. All right. So there's really three approaches to long-term care coverage. One is governmental through Medicaid and through the state of Washington with this new long-term care mandate. Now, Washington State's the first state in the country that's actually implemented something like this. We know of at least 5 other states that have legislation in process right now to come up with a similar type of approach. So there is that as a safety net. You also have long-term care, private long-term care insurance that has a couple of different flavors that we're going to get into in more detail that you can use as a way to opt out of the system. And as Dan said, for those who have the assets, they may decide that they can self-fund their long-term care expenses down the road. And I couldn't agree with Dan more. Why would you? Because of what you have to set aside to be able to take care of an eventuality may not be worth it compared to the cost of long-term care insurance. So the state is going to take a look at the opt-out strategies, and basically what they've done is they've set some guidelines as to what they would accept as private insurance alternatives that would allow you to opt out. Now, please know a couple of things here. First of all, First off, there is one opportunity to opt out. This isn't an annual opt out. This is not like health insurance. This is a one-time to opt out strategy here. So what you have to do is you have to have some kind of a private care, long-term care insurance that qualifies to opt out, and you have to have it in place by November 1st of this year. So we have about 2 months left, 2.5 months. That's going to come and go really quickly. The insurance that would qualify for you to opt out has to be a qualified long-term care policy or an insurance policy that has a long-term care rider attached to it. Okay. What would not qualify is policies that have a lump sum payout. And there are some chronic illness riders on existing insurance policies that some people may already have. Unfortunately, that will not qualify either. So there's a lot to talk about here. So let's kind of get into this. And Dan, do you want to talk about traditional long-term care versus the hybrid approach?
Sure. So
Okay.
there's a couple different options in insurance, and one is what is exactly called a traditional policy. It's like auto insurance. I hate to put it that way, but it's the easiest way to say it. It's like auto insurance, and it's actually what I have, because when I bought my policies 10 and 15 years ago, the hybrid model or even the asset-based model was not available. It didn't exist.
Right.
So you pay it pretty much for the rest of your life on a monthly or annual basis. And if you need it, it's there. And if you die without using it, it's gone. There's nothing that can be, so use it or lose it. That's the model I'm under, because that's all that was available, and those still exist today. The asset-based, I like that, live, quit, or die.
Yeah.
I hadn't quite seen it put like that before. But the asset-based model is that and correct me if I didn't explain this correctly. It's a life insurance policy, a whole life insurance policy that is set up to return 100% of the death benefit. And if you quit it, you can get some of that back. But and a lot of times these are second to die policies for couples and things like that. I think it's a better model than traditional. I'm guessing you have a hybrid plan there on the next, do you have?
Actually, we lump that under the asset.
Okay, yeah, hybrid. What I would call this has been I've used Lincoln and Nationwide. They're really good at this.
Right.
These are also whole life policies, but I tell people, don't think of it as life insurance. You're paying over the course of either maybe a 10 or 20 year period. You can pay longer, but it makes most sense at 10 or 20 years. You're paid up. You're completely done making payments at whatever point that is. And the insurance is there to secure as security for your life or for the long-term care. So if you die, you get your beneficiary, somebody you love, is going to get every single penny of what you invested in it back. You might have some money back available as a surrender if you want, but if you make it to the point that it actually cashes outright, you probably want the long-term care insurance. And then the long-term care insurance is there. So I find this model to be really great because you're going to use it one way or another. You're either going to die and somebody you love is going to get the money back. You're going to pull it out and get some of that or all of it back, or you're going to need it. Does that help, David?
Yeah, well, and this is why we label it the way that we do, because with traditional long-term care insurance, if you looked at your balance sheet, that is strictly an expense. When you take a look at the asset-based or the hybrid models, someone is going to benefit from it. So we consider that an asset, whether you benefited from it because you needed the long-term care coverage, or whether you decided to quit the policy 20 years from now, you'd get some kind of return on the cash value inside the policy. And if something unfortunately happened to you, then there would be a death benefit that would go to your beneficiaries or your heirs. So someone gets a benefit. And that's why we call them asset-based. If you take a look at that, how you would put that on your balance sheet. But
Hey, David, Joe has asked a question now, and he's reiterated, and I don't know if I know the answer for sure, but I'm going to read it out loud. And between the two of us, I hope we can
Sure.
answer it, because I think I know the answer, but I want your help. He asks, he's retired, so he's not subject to the tax, but his wife is. She is eligible for RETSL, which is the veterans. But I believe she still, as a W-2 employee, that doesn't exempt her from not paying the tax. I believe she still is subject to the tax. Do you know, am I right or not?
well, my understanding is that state employees would be exempt from the tax.
But she's not a state employee.
She's not a state employee, so most likely, yeah, if she's getting a W-2, then she would be obligated to pay into the system. Now, it depends on how old she is and how much longer she plans on working. It may be just the cheapest thing to do is just to stay in the system and pay for as long as she continues to work. But
I'll answer it in the Q&A as David continues.
Yeah. Okay. So this kind of just adds a little more fuel to the fire, so to speak, as Dan, I think, so appropriately let us know about the costs of long-term care that most of us are going to face in one form or another. But if you take a look at just using a low-cost inflation rate for medicine or medical care, and I guess before I go there, I should probably preface this by saying, if you take a look at inflation rates over the last 15 years, inflation has been really quite low from a historical perspective. Some of us that are old enough to remember back in the 80s when inflation was running at about 15%, interest rates were 15 to higher. Those were the heady days for inflation, but it's been rather subdued. Now, the one caveat to that is that medical costs have continued to outpace the generalized inflation rates in America for the last 40 years. And they continue to do so today. In fact, the last time I looked, I think medical inflation has been anywhere from 5 to 7% over the last 15 years. That's substantially higher than the rest of the inflation from consumer goods and spending. So even if we cut that in half and said, well, look, we think from this point forward, medical inflation is going to be much more subdued. We're looking at maybe 3.5%. You can see that if someone had to get a private room in a nursing home, which today costs about, well, over $100,000. In 10 years, that's going to be almost 150, and in 20 years, it's going to double. So it's not something that is going to stay static. Most likely, medical costs will continue to outpace the rest of the items that could produce inflation for us. So it's something that we have to keep track of and be aware of. We're getting close to the end of the presentation. This is one of the things that we put in that we think, and I think Dan probably feels the same way. In normal situations, if we were taking a look at long-term care insurance, we would take a look at it in the context of an overall financial plan. It is one of many things that we want to consider when putting together a plan that will hopefully not guarantee, we can't guarantee anything, but hopefully put people in the position where they have a pretty good opportunity to have the kind of retirement that they want, and be able to take a look at all the things that go bump in the middle of the night once you get retired. But we encourage people that are listening to us today that regardless of what we say from this point forward, take a look at long-term care as something serious, and that it's not just for someone else, because all of us are most likely going to have some kind of flirtation with a long-term care need. And if you put it in the right context, it could be something that can be managed today in a way that is really thoughtful and will pay off for you in spades down the road. Okay, so I think we're at that point, Dan, where we need to tell people a few things. So we talked about opting out. We talked about hybrid. We talked about different strategies that are available. As Dan mentioned when we first started, Washington State, I think, has started to realize that a lot of people have decided to opt out of the system and have pursued individual private carriers to find a private solution. I think it's surprised the state in a way that they're actually much more volume of folks trying to opt out of the system than they expected. The other thing that's happened is a lot of the private insurance carriers are concerned that a lot of these folks who are attempting to opt out of the system will cancel their policies soon after the opt-out period, which unfortunately is a lose situations for insurance companies. Nobody wins in that deal. And so what has happened when we first started, Dan, I don't know about you, but when we first started down this road 3 or 4 months ago, we had six prominent carriers that were in the long-term care arena. And quite quickly, we lost 4 of them. And we were kind of down to 2 or 3 that were still in the marketplace. And I will tell you that last Friday, one of those 2 carriers drew a hard line in the sand and are no longer taking applications. And the main reason why I believe is because so many applications have flowed in that they don't feel they can handle the volume to get people set up so that they can actually have a plan or a policy in place before that November 1 deadline. The last carrier, which frankly, in my opinion, was one of the best carriers out there, has also drawn a line in the sand as of this Friday, tomorrow.
Yeah,
so even though we've talked about long-term care and the opportunity to opt out, that window has in essence really closed. Dan?
Yeah, and this is really hard for, I've talked to people who are maybe sometimes now just hearing about this. So I want to be really clear. And I don't know, David, if you're working with One America, that's who you're talking about. Friday the 13th, my deadline to get anybody in is 9 p.m. Pacific time. I double checked today, and they're going to look at timestamps. I promise you that for a completed application. The other thing that One America did, and they're the last carrier I have. After Friday, I'm done. I have nobody.
Same for us.
One America has mandated that at the first year, the annual premium be paid. After that, you can go monthly, but that is a change that they made to avoid the purchase, pay a couple months, opt out, and cancel. So I actually have to take a check for the full annual premium. And David said it perfectly. You would think that insurance companies would be drooling over this because they're going to insure a lot. They're not. They're jumping ship. They're not dumb. They're smart. They understand what's going on, and they've hit their capacity. I'm happy, and I'll just put this out. And David probably. I'm happy to chat with anybody about this if you need to talk, but it needs to be today. I would probably need to hear from you today because I need to get an illustration and we would have to work on the application. I'm happy to do it. I'm working on about a dozen others who I'd already talked to, but the reality is for all of you out there, if you're a W-2 there and you don't have long-term care insurance in force, I'm afraid, and I'm sorry to say, there are almost no options left past Friday.
Right. That is true. The same for us. And I know, Dan, you may want to put up your contact information. I think
it's on my name. So if you toggle over my name, I put my email.
Okay. So I think Teresa, I think you're sending the slide deck out. So our contact information is in there as well. But like Dan said, we are quickly running out of time. So, but I will leave you with one other thing before we go to Q&A. And that is that for some of you folks, especially the younger folks who are most likely going to be staying into the system, there are a lot of different ways to skin the cat, so to speak. You know, right now, the premium outlays are relatively small. I mean, there's not there, and granted, there's not a lot of benefit involved. But if you take the message that Dan and I are trying to communicate, and that is, you can't look at long-term care as someone else's problem. Eventually, it's going to affect you. And so if you take a look at it in terms of an overall financial strategy, long-term care should be part of it. So the state benefit isn't much, but if you take a look at other strategies, I call them tag-along strategies, where you set up another bucket that's outside of this, where you can put additional dollars in there, you can have something that is really meaningful for you 30 years down the road. Be happy to talk about how that works. I know Dan will as well. So give us a call. And I think at this point in time, Kathy or Teresa, do we have any questions that we can address at this point?
Dan's been doing a great job typing the answers, and if folks aren't tracking that, I would encourage you to do that and look at the answered ones. I also wanted to invite Monica Blackwood to kind of share what she's hearing from a staffing perspective.
Hi, everyone, and thanks, Kathy and Teresa, for inviting me to jump on with Dan and David. They are a huge wealth of information regarding this topic. From kind of the employer standpoint, as an employer, if you are not communicating with your teams and your workforce about this and haven't been, then start that yesterday, because last thing we want is a bunch of questions the first paycheck in January, when they're looking at their pay stubs going, hey, wait a minute, how come there's some additional deductions happening out of my paycheck? And likely that will, if it's anything like people that I know, it'll actually be February or March before they look at their first pay stub and realize that they've been having this deduction come out. Make sure that you're talking with your teams about this, so that they're at a very minimum, they're aware that this is going to affect their net income, right? And then as much as you can, be talking to them about all of their options. It doesn't mean that you as an employer need to fund any options, but do your diligence to be a partner alongside your employees, so that they know where to find their options, and talk with great people like David and Dan, so that they can make their own decisions, as opposed to have the decision made for them, as as the wire gets short here, with being able to opt out and all of that. But from an employee standpoint, the more communication, the better. That's always the case with any topic, and it's the case with this one as well. So that's what
Monica, can I ask a question?
Absolutely.
I always have questions for Monica. She's way smarter than me, and I'm always happy to talk with her. I brought up Joe's question, and I wanted to make sure that I'd answer that. I don't think whether you qualify for a Retzel or not exempts you as a W-2 from paying the tax. It's if you're a federal employee that exempts you, but if you're not, every W-2, I think, period, unless they purchase a personal or group policy,
Right,
has to pay the tax. Am I correct?
That is the way that I understand the legislation being written now. And granted, there's always opportunities for that to change and different language to come into play. But as it stands now, yes. And I'd also say, I think, Dan, you talked about this earlier, but it's not just the dollars that come into play for this. It's also different options or different fundings, whether it be bonuses, stock options, things like that also play into the amount that
that's right.
they taxed upon. So it's not just that, initial paycheck.
And Monica, I think early on, some businesses said we would be happy to pay that, but it is not allowed. It must be paid by the employee, correct?
No, I mean, if the employer wants to offer that coverage,
They
they
can.
They can pay it. The employee still has to go and submit that to the state. The state doesn't know how it gets paid, as long as they are covered, and they would still have to submit that to the state. Just remember that if they were to leave, whether or not that coverage is portable or not, would have an effect later on, because they're not technically eligible ever again to be a part of the program.
That's right.
They opt out, at least at this point. Things can change, right?
Yeah. Yeah, there is a lot of nuance, obviously, and the picture isn't really as clear as we would obviously like it to be at this point in time. I'm sure more clarity will be forthcoming, and we'll know more. And there is, there is an outside chance that this gets challenged legally, and there's other things that are going on here that may not actually become visible to us for some time, but we can't act on possibilities. We have to act on what we know is in front of us at this point in time. So, yeah. Any other questions?
And I think you guys might have covered it, but I'm going to say it again. The other thing is I get a lot of questions about employers who have employees in different states, and maybe they're working from Idaho, or they're working in Idaho, but
right.
the organization that they're working for is a Washington state company. As long as you are receiving a W-2 that has Washington on it,
yep,
you're subject to that.
Yep,
to this time. So.
That is correct. That is correct.
Even though they would be ineligible because they don't live in Washington.
Yep.
Right. There, yep. That's just one nuance of it all.
So there's some things to review, definitely. And
I have a quick question. If you don't do anything, and I think a lot of people won't do anything because they don't know that they even should, what is the consequence? You get the tax assigned, right?
Right, correct.
But do you get a benefit? I mean, do you still get a
yeah.
Yes.
Yeah, you get the word. First of all, long-term care insurance is going to continue on well after this. Insurance companies will flood back in.
Right.
The reality is what David showed very starkly is that you're not the tax benefit doesn't give you much. You're still going to need long-term care insurance. You're just going to have to pay two. I think you're going to either have to find a way to fund long-term care insurance personally, and whatever you might get from the state would be available at the same time. This just happens to be a very unique one-time only opt-out period where you can get your own plan and not have to pay the tax.
Okay, thank you.
So when a new employee comes on board, is there an opt-out period for them, or just say it now?
So what happens is that, or at least we're told this happens, is once somebody submits to the state that they have a plan, and the state then deems them exempt from the plan, they will get a letter. The employee's responsibility when they go to their employer or they switch employers, etc., the responsibility is that the employee will show the employer, give them a copy of that letter, so that the employer then can turn off those deductions from their paychecks. If they don't do that, or they do that late, the employer is required to make those deductions, and there are no refunds. So if I'm a new employee and I go 2 months later and say, oh, by the way, I'm exempt, the employer cannot refund me those 2 months of premiums.
Now, that's what I was saying at the beginning of this program, that this is strictly an employee-based responsibility. And if they don't take that responsibility, if they move to a different employer, it's not on the employer, it's on the employee.
And listen, if you've already got, I've talked to people who already have long-term care, great.
Right.
Or if they purchased it during this time, here's an important thing. The opt-out period begins October 1.
Right.
And so you opt out through the Employment Securities Department website, not like they've not had any problems, but that's where you opt out through. I would highly recommend, I'm going in on October 1. I'm sure it'll break the system, but I'm going in early because who knows how long it will take for them to approve you. If you try to go in on December 15th, even though you've had a qualifying policy, if they don't get you till January, you're paying the first quarter. And as Monica said, you don't get it back.
That's right. That's right.
Do we know if there are any accommodations made for folks whose first language is not English and may not even have any knowledge of this or understand?
I can't address that. I don't know. I assume they do, but I don't know.
Okay, because we do have, many employees and
Right.
business owners whose first language is not English, so.
I actually believe that some of the information on the website that's directly for this does have information in one or two other languages, maybe more than that, but I'm thinking that there's at least some Spanish in there from what I remember.
Right.
Okay,
Well-
we're almost at time.
Well, I think the last thing I'd like to say, and I think I'll echo what Dan also probably is feeling, that we're here as a resource for you. We still have, it seems like we have the same number of participants still online that were joining us at the beginning. Give us a call. We'd be more than happy to have a conversation about your specific situation, albeit, the opt-out period is pretty much over, but we certainly can talk about long-term care and and how it may fit into your financial situation. So please use us as a resource.
Hey, Monica, really quickly, I just answered a question from Marcus. I
saw
put
that.
my understanding was if you want to, you're probably better suited to answer that.
I was just about to answer it, and then I saw you had jumped on. Marcus, as far as I know, it's just what's on your W-2, not on anything from your 1099.
Yep.
Okay, so Teresa, do we have any last slides to share? Again, thank you, David, Dan, and Monica for sharing what you guys have been working on for months. I believe Monica alerted to the KETA board early in 2021, maybe late 2020. So it's been simmering. And it seems to, just like the changes of insurance companies pulling out of Washington.
Yeah.
So thank you. And I encourage you to check in with our resources. They are all really great at giving us updates that we would post on our blog and social media. Teresa has noted that we will get this video and the presentation up this afternoon once the video processes, and we hope to see you at our next events. Also a reminder that, if you just have quick questions for your business, contact our local Small Business Development Center. And finally, the KETA team is here to help you. And we, of course, would love for you to engage with us on any of our committees or as a resource. So please contact us and let us know how we can help you. Or if you have thoughts for us, we want to hear them. So thank you again for joining us and have a great day.
Thanks, everyone.
Thank you.